consumers who are new to the financial advisor space, what our company allows them to do is get a customized relationship with a financial advisor.
One of the things that really defines the personality of Datalign as a company is our origin. Very close to the MIT ecosystem, very much intertwined with data analytics.
We are looking to create the perfect match between those consumers and the financial advisors. The reason why this matters for financial advisors is because
Hi everyone, I'm Julian Franky with Datalign Advisory, and today for our Perfectly Aligned podcast, we're going to be talking to Matt Hartmann. Hi, Matt.
Hello, my name is Matt Hartmann, work on the data science and analytics team. Excited to be here with you, Julian.
Yeah, I'm excited as well. So Matt, I remember when I joined Datalign, this phrase got thrown at me. We run a second price auction. And I remember trying to kind of like figure out, and before doing my research, I wasn't really clear on what it meant. What do you say we kick it from there?
Sounds good. So I think it is important to think about auctions in the physical sense first, and then how those could be translated into online auctions. So I think everyone's familiar with the gavels, the auctioneers selling a single good, and you have bidders in that room. What we can do online is run multiple of those auctions in an online setting and get the matching between supply and demand at scale. And what an auction allows you to do is that efficiency in clearing supply and demand. Anytime you create a process for matching supply and demand, you're going to be creating certain incentives and constraints on the participants. So there are many different types of auctions a designer could use. There could be a first price auction, a second price auction, could be random assignments. All of those are going to have different implications for the participants in the market. So a second price auction is what we use at Datalign, and it has many unique features that help both our users and the financial advisors, which we can get into.
So I think everyone is pretty familiar with the first price auction. You maximize the bid and you go incrementally to kind of like make sure that you're never overpaying, right? You try to always bid the less that you can.
Yep.
What's the difference between that and the second price auction?
Yeah, so for a first price auction, what happens is every participant bids, and then the participant with the highest bid pays their bid for the right or the product that is under auction. And that has certain incentives that come with it, where the participant is going to want to bid the smallest amount possible that allows them to still win. What a second price auction lets us do is it creates totally different incentives for the users. So in the second price auction, the participant with the highest bid will pay the price below them. And that means that truthful bidding is the dominant strategy under that system. So dominant strategy means you're never better off deviating from that strategy. So what that allows us to do is the goods, we create a match between our users and the financial advisors with the financial advisors that value those users the most and are most tied to be able to help them with their services, instead of creating a match based on someone who is better at gaming a system, like a first price auction.
Okay, so my takeaway is in a second price auction, the highest bidder wins. You pay the second highest price plus $1, right? And this incentivizes our bidders to bid your true value.
Yes.
Right? Okay. So true value is kind of like the defining trait that makes this work. Let's dive into true value for a second. Like what does that really mean?
So true value, it relies on the participants to determine what that user, what that relationship, what that product is worth to them. And then once they arrive at that valuation on their end independently, then they are able to bid according to that value. And what's beneficial about that is it is a system where they do not have to be concerned about strategy, gaming the system, what other participants are doing. It is what is this worth to me?
Okay. So let's take it back to the first price auction, because it's
Yes.
just easier to kind of like wrap your head around it. So in a first price auction, I go into the auction, I know the maximum that I'm willing to pay, or at least I have an idea, right?
Yeah.
Like, how much am I gonna pay for this vintage car? And I kind of like know that number. I read the room and I bid according to what I'm seeing.
Yes.
Right. But in a second price auction, first, I have no visibility into what other people are doing.
Mhm.
So I need to rely on the true value, meaning what that thing is worth to me, to kind of like set the expectations of what's going to happen.
Mhm.
And so when I enter the second price auction and I'm bidding what the asset is worth to me, that's the strategy that I should pursue, right?
Yes, it is. And I think we could do a basic example looking at a first price auction and then looking at a second price auction and then seeing how the thinking of the participants is different. So let's say there is an auction for a vase and the vase has an objective value of $100. If I want to win that vase in a first price auction, anything below $100 is a profitable deal for me on that. So I would look at what other participants are doing and I would bid the smallest amount possible to still win. If I could bid $20 and no one outbids me on that, that's great because I have that profit of 100 minus 20, 80. However, it is dependent on what other participants are doing. If I get a sense that people are going to be bidding above my 20, I need to be constantly increasing my bid, constantly monitoring and updating my strategy based on what other people are doing to get a profitable deal. So in that setting, there is the strategy aspect to it. If we looked at that same good, the vase worth $100 in a second price auction, the optimal strategy someone could take is to bid their true value, bid that $100. Let's say if I bid less than $100 and I bid $50, for example, I could lose out possibly on a profitable deal. If someone bid 70, and I would lose that auction because they had the maximum bid. Whereas if I bid 100, I could have won it at 70, had that $30 profit. So in that case, you could see bidding less than what it's worth to you is going to cause you to lose out on profitable deals. If you bid more than what it's worth to you, that causes you to be exposed to unprofitable deals. So if I bid 150 and someone happened to bid 120, I would win it at 120. And you could see that there is that negative $20 profit that I get. So you could see the difference in strategy between those two. The first is strategy requires constant updates, requires knowledge of what other participants are doing. Not necessarily going to who values it the most. It is who can better play in that system. Whereas in the second price auction, it goes to the participant who values it higher if they bid optimally.
I see. So my biggest takeaway from what you just said is there are three strategies in which we can approach a second price auction. You bid your true value, and then it's a good outcome because you are always paying up to that amount, right? You bid more than you value, which you can, but you're exposing yourself to overpaying, which is questionable if it's a good outcome or not. It shouldn't be because you're over your true value. And then the third one, you bid less than you value, which kind of like makes sense because if you go into a second price auction with a first price auction mentality, you kind of like fall into that bucket, right? The problem is you're missing out on good deals. That's okay. So interesting. But we do get questions sometimes on the lack of visibility in a second price auction, right? Because you don't really know what others are doing. So that usually, I would say it's not unreasonable to see someone trying to reduce the bid in order to find a bigger upside, if you will. Would you mind speaking to that?
Like you said, it is that balance between getting those profitable deals and then what you are exposed to potentially paying. But in terms of that proof, it is if you bid that true value, we'll never have a better outcome. But what the second price auction allows us to do is we give flexibility to the different participants to arrive at their own valuations. So if you and me value something differently, you might see it worth $200. I might see it worth $100. We are both able to, on our end, back into what a good deal would be for us. and then make that bid accordingly and get those outcomes.
How do you think about the calculation around true value? Because it's really kind of like the underpinning number that will determine if you're in a good setup or not, if you're set up for success or not.
Yep.
How do you approach true value?
Yeah. So the way we would look at true value is we would have to consider probabilities. So this is what is using an expected value framework. You look at the different probabilities, and then you look at what you would receive in each probability. So for an easy example, let's say we're looking at coin flips, and if I get heads, I get $10, and tails, I get nothing. So if I have a weighted coin that always lands on heads, the expected value of me entering into that transaction is going to be $10 because it's that $10 payout times 100% probability.
Mhm.
If we had a fair coin, it would be $10 times that 50% probability, which is $5. So the two components to be aware of are the payout in the state where the relationship converts, and the probability of that happening.
Okay, so for the world of financial advisors, the payout is the expected cash flow of a customer during their lifetime with the RA, their tenure.
Yes.
Right? And the probability of outcome is Datalign's conversion rate, which is the thing that we optimize for. Like quality is the foundation of the product that we have built.
Yes.
So you have to take a look at those two. Let's focus on the cash flow because conversion is really up to our system and how we optimize for that quality. But the calculation of the value is really up to the financial advisor, right?
Yes.
So what are ways that we could approach that?
So different financial advisors might have different periods over which they want to value that relationship. So definitely having that timeline is going to be key. And then there are a few different factors in the payout. First, it would be the assets under management of the relationship, the income of the relationship, the investment returns. Those are all going to add to your yearly cash flow. And then we can look at some of the prevailing conditions in the market, like interest rates, to discount those future cash flows into the present. And then applying that conversion rate, you get the expected value of that. And financial advisors might have different fee structures as well, different operating expenses that can be factored into their bid as well to make sure they're at the profit that they want to be at.
Yeah, and I think one of the things that really makes our platform stand out is the flexibility that we give advisors to really hone in on the customer segment that they want to target. And that really has an effect on that cash flow calculation, because if you're targeting a specific age or a specific income bracket or a specific AUM range, it's really going to move the numbers in one direction or the other. But I would say the beautiful thing about the second price auction and the mechanism of targeting very specific segments is that you can price each one accordingly to what makes sense for that specific segment.
Yes.
So I just, it's one of those things that really makes you think about, am I going to focus in short-term, mid-term, or long-term growth? And then how do I value the people within those segments in order to make sense and build the firm for tomorrow and over time?
Yes. I think we could also think about what that does for the users who come to our platform too. You can be certain when you come onto our platform and you're trusting us to find that financial advisor, that relationship for you, that to be on our platform, you have to be vetted. You have to go through a rigorous process. You have to be able to provide the services that most users are looking for. So we have that baseline level of quality with advisors. But through this system, you are going to the advisor who values you the most highly and can help you the most, as evidenced by their willingness to seek your business. So we have seen in this industry at times it can only be accessible to some of those higher AUM brackets. But regardless of your situation, when you come to the platform, you are going to the firm that values you the most highly.
And how do you see that relationship? It's a common question that we get.
Hmm.
If I'm a firm of this size and I jump on your platform, how do I play against other firms that may have a larger budget or may have just more a system in place that's more robust than me to process these leads? What do we do to level that playing field
Hmm.
between the different firms?
So I would say there are a few things. I would say the first thing that would be most important is um, being honest about where the firm is right now and what is profitable to you. That way, you're only entering into profitable deals. And with the second price auction, if you bid optimally, you will only be entered into those auctions that you find profitable and at
Mhm.
that price. One, if you want to seek more volume, there are ways to, on your end as a firm, optimize for the digital lead process, which our team at Datalign does help firms get up to speed on some of the best ways of working there. And there are also different niches that these financial advisors can find themselves in, depending on geography, specialties, willingness to be in person. We have seen advisors who are willing to um, go in those spaces, create really lasting relationships for both sides.
I agree, and it's a common. I spend a good deal of my time on the strategy of our new partners,
Hmm.
and one of the questions that we get frequently is, "I know that this pocket of customers works for me.
Hmm.
I've seen success in the past here and here. What else can I explore
Hmm.
to take on those leads that are currently not matched or
Hmm.
sold for a very low price, or like how do I expand beyond what I know works for me?" It's usually a very interesting conversation.
Hmm. Hmm.
What are your thoughts around that expansion?
So at our firm, we do have some different processes and tools we use to help advisors find expansion opportunities, opportunities that are outside of where they would traditionally target. We do look very heavily at geographic data
Mhm.
and looking for opportunities there to expand.
I love the geographic part of this, and it's probably good topic for another
Hmm.
one of these episodes. But I used to have someone that told me that if everything in the world is related, the things that are more close to each other are more related. And so geography kind of like opens the door
Hmm.
to exploring that.
Hmm.
And it's usually a big part of the bidding strategy that we set up front.
Hmm.
Because yes, the metro areas are where we want to be, but how do you think about the AUM that I capture from a lead in a metro area that I'm targeting versus the AUM that I capture from someone else that is, I don't know, 60 miles away from that metro area? You
Hmm.
know what I mean?
Yeah, I know what you mean, and I think for some of these firms that are looking to differentiate themselves in the marketplace, being open to those expansion is key.
Okay, so what do you say if we talk a little bit about return on investment?
Yeah.
It's usually a very big thing.
Mhm.
When we talk to a potential new partner, we always
Mhm.
talk about the what is this thing gonna look like down the line? Like
Mhm.
where can you expect to be 5 years, 10 years, 20 years from now?
Mhm.
So let's talk about that for a second.
Mhm.
What do you think about the ROI calculation when it comes to digital leads?
Yeah, so I would definitely look at the ROI in terms of that expected value framework, for each lead. In that state when it converts, what is the payout I can expect over time, whatever the time horizon may be? And then that underlying conversion rate. And then factoring in the different fees, my own firm's fee structure, the investment returns I can expect in my funds, even tax treatments, perhaps. And that could differ by firm, but we really give that customizability to make sure that they are getting those leads that align with what makes sense for
Mhm.
their yeah, for how
Yeah,
their firm is set up.
I agree. So one of the things that really defines the personality of Datalign as a company is our origin. Very
Mhm.
close to the MIT ecosystem, very much intertwined with data analytics, and you're from the data analytics team.
Mhm.
How do you think about our process and just in general how we tied data into our decision-making process?
Yeah, I think data is very key for those decisions for the financial advisors in terms of um, what makes sense, finding the profitable opportunities, expanding in terms of their volumes. Like we talked about earlier, most of our expansion work comes through our analysis of geographic areas, and we have some like proprietary processes that allow us to complete that geographic analysis and get advisors into markets that are underserved and have those profitable opportunities. And being data driven also allows us to adapt quickly with some of our product offerings.
Mhm. And what do you think are the best practices that we see? If you had to nail it down to best practices, no names, just best practices. What are the behaviors that we see from our top performing partners that really make them get an edge on our platform?
I would say willingness to approach the auction from a quantitative framework and with probabilities in mind, and also giving yourself a long time horizon for those probabilities to play out. It is a game of sample sizes and distributions at times, but the financial advisors who have a quantitative framework to know what a good deal looks like, and then the willingness to expand and place themselves in opportunities to capture those deals, those are the ones that do well in our platform.
Yeah, I agree. And the volume part is really kind of like a defining thing because first, yes, it's a numbers game, and two, we also need a minimum amount to see statistical success.
Yes.
So it's one of those things that I like to compare to rocket fuel. Like you need a minimum amount of rocket fuel to get out of the atmosphere. If you put 90% of that fuel, everything goes to waste. You really need that. You really need to hit that threshold in order to make it worth your time. What have you seen around those numbers that we need to see success come to fruition?
Yes. So again, like returning to the coin flip example, you can think of that successful state as when you flip a coin and you get heads, just assigning a different probability than 50% to it. And you can use statistics to get a sense of how many coin flips I need to take for me to have 95%, 90% certainty, statistical significance that I am going to have that profitable um, outcome for my firm.
I agree. So if we look at growth for an RIA growth, if you want to grow beyond referrals, you need to look at lead generation, right? That is a channel that you can pour dollars into it and get leads on the other end. You can get consumers on the other end. So it's a scalable mechanism to grow your firm. And quality is a defining trait because if the quality is there and the cash flows are there, the second price auction makes sense because you're getting a return on that investment. And so I would say it's really about, do you want to grow your firm beyond referrals? Then a lead generation platform is for you. Do you care about the quality of the customers that are coming through? Then our platform is for you.
I also think it's about meeting consumers where they are. We talk a lot about the great wealth transfer. Some of these younger demographics who are new to the financial advisory space, but they've been so used to digital process for finding goods and services across all other walks of their life. And what this allows advisors to do is meet those users in the same way.
Thanks again for watching. I'm Julian Franky, today with Matt Hartmann. If you're looking for a financial advisor or you're looking to grow your firm, please do visit us at datalignadvisory.com.